As we approach the end of the year, it's important to have an idea of what your income tax situation is going to look like. Depending on your objective, steps can be taken to either lower your income when you're in a high tax bracket or increase your income when you find yourself in a lower tax bracket compared to other years. Let's talk about some common tools that can be used to accomplish these objectives. First thing is to fund your pre-tax accounts. These are your 401ks, 403bs, IRAs, and HSAs, to name a few. This is a good idea when you're in a high tax bracket because contributions to these accounts turn into deductions from your taxable earnings. Another strategy is to lump your itemized deductions. If your itemized deductions seem to always be right around the standard deduction amount, this could be a great strategy for you. This is achieved by timing deductible expenses so they occur in one year instead of multiple. For example, a taxpayer who gives $5,000 to charity every year might consider gifting $10,000 to charity once every 2 years. And in the giving years, the taxpayer could benefit from a higher itemized deduction while taking the standard deduction in the non-giving years. As an added bonus, a taxpayer may even be able to take advantage of a donor-advised fund. Here, you can make lump sum tax-deductible contributions to the fund, while payments to the actual charity can continue to go out on an annual basis. Next, let's talk about tax loss harvesting. This is done by making trades in your portfolio that give you a current year tax benefit without significantly changing your overall economic position. If you haven't seen our video on tax loss harvesting, go check it out. In addition to tax loss harvesting, tax gain harvesting can be useful as well. Here, taxable gains are intentionally realized within the portfolio to take advantage of the 0% long-term capital gains tax bracket. And many people don't realize how large this 0% bracket is. So in 2024, for a married filing jointly couple, the top of the 0% long-term capital gains bracket is $94,050. Now remember, that's based on taxable income. So after taking into account the standard deduction or itemized deduction, you could have a married couple with well over $120,000 in total income and still be in the 0% tax bracket for long-term capital gains. Lastly, let's touch on Roth conversions. If you expect to be in a higher tax bracket in your retirement years than you are in the current year, this is a great way to pay tax at the lower rate now and let those funds grow tax-free in a Roth account until they're eventually used in retirement. The most effective tax planning starts with a tax projection to figure out where you're at now and an expectation of what your income is going to be in the future. From there, you can work with your advisor to implement appropriate tools and strategies to successfully lower your lifetime tax bill and ensure you're not paying more than what's legally required.